thank you all for coming. And Travis, thank you for that wonderful introduction. It's really been an amazing experience building North Island Ventures with you over the past 5 years. I'm just so happy we had that dinner. And I'm really excited for what is to come over the next 5. So today, I'm going to talk about what I think of as the future of crypto, and what I've been calling Finance 3.0. But to understand that, I want to start at the beginning. So this news headline was included in the first Bitcoin Genesis block, right? Satoshi's vision for what he built was to rebuild an ailing and antiquated and inefficient financial system. And over the last 16 and almost 17 years, we've explored many ways to use blockchains and crypto networks, many places and industries that we thought this technology could apply. But kind of looking back with some hindsight and looking forward, I really think that Satoshi's vision was correct, right? That the biggest idea for crypto is to rebuild the financial services industry. And I believe that for 2 reasons. The first is that it accepts blockchains for what they are, right? Blockchains are financial infrastructure. They're global asset ledgers where you can issue any asset with provable digital ownership. And their decentralized nature enables you to both agree on what's in the ledger, but also operate globally instantly at scale, right? Decentralization is what enables us to send a stablecoin payment anywhere in the world in a couple seconds. But that decentralization comes with a trade-off, right? Like there's a computational tax to agree on what's in this ledger, which means that we're never going to build a world computer, right? These databases will never be big and fast enough to compete with centralized peers, but that doesn't matter because decentralization gives us something that the finance industry doesn't have, which is a global ledger that anyone can access. And the second reason I think this is the big idea for crypto is that I actually believe that finance is more important than the internet. Right? When people think about finance, many of their first thoughts are Wall Street and greed and speculation. But that's the wrong lens for finance, right? Finance is the invisible fabric that orchestrates our lives. And to understand, it's why we build huge economies. It's why we exist in the world we live in today. And to understand why I think about finance with this lens, I want to do a simple thought experiment. So today we're standing in the beautiful Pioneer Works building. I noticed in the picture I have, we don't have these amazing stained glass windows, which I wish I had. They're the coolest things I've ever seen. This building was built in the late 1800s at the beginning of modern finance, right? Back then we had paper equities, we had a fledgling sovereign bond market, and a few bills of exchange to move value around the world. And these were the buildings we could build. Today, we build buildings like this, one Vanderbilt. And if you go to people on the street and you say, why can we build this today when we could only build Pioneer Works 200 years ago, 150 years ago? And people will say, material science has progressed, technology has progressed, but what I would actually tell you is that it's finance has progressed, right? And so to understand why I feel that way, I want to go a level deeper on the thought experiment. So to build a building like this, you always have to start with a real estate developer. Now, this real estate developer never has enough money in his bank account to build these buildings, so he has to go get a commercial mortgage from a bank. But the bank doesn't want to hold the commercial mortgage on its books, so it bundles them together into a commercial mortgage-backed security, which it sells to investors, moving the risk off its books, putting more money in its coffers, enabling it to build more, to issue more and more loans, building more and more buildings so we get all the skyscrapers in the world we have today. So now the real estate developer has his money. He signs a contract with a construction company, but he doesn't pay all up front, right? He pays on a schedule. So the construction company doesn't have enough money to hire its workers, rent its cranes, and build its materials. So it goes into the market for short-term commercial paper, right? A loan that's 9 months or less. He again goes to a financial intermediary like a bank, but the bank doesn't want to hold this risk on its books. So what it does is it bundles it up with other short-term loans in a money market fund, giving investors stable yield, taking the risk off the bank's books, putting more cash into its coffers, enabling it to build more and more loans, enabling more and more businesses to build bigger buildings, bigger factories, and kind of the economy to grow. So now finally the construction worker has his money, and in this thought experiment, he needs 2 things to build his building. He needs a crane and steel. But how does the crane company build its facility to build cranes? So in order to get the working capital to build its facility, it issues a corporate bond. But the market deems this facility to be risky, and so it only gives them a variable rate mortgage. The mortgage will float with the market, but the crane company wants a fixed cost. They won't build the factory until they have it. So they go and get an interest rate swap, a derivative. Both of these trades go through a financial intermediary who finds investors on the back end to execute them, take the other side of the trades. So now finally the crane company has a fixed rate mortgage. It builds its factory, it can build these cranes, it sells one to the construction company. Now the steel company, its main input is pig iron, but it's worried about the future price of pig iron in the next 6 to 12 months. So it goes and gets a pig iron future to hedge out its commodity risk. In addition, it has 4 currency risks. It has an RMB currency risk because he's buying pig iron in China. He has a Malaysian factory, and he's selling the steel to the EU and the US. So he goes and gets a complex FX swap, swaps out, hedges out all of its currency risk, and now that he's hedged out his commodity risk and his currency risk, he's willing to build steel. Both of these trades go through a financial intermediary who finds investors on the back end. And now finally, we're able to build this, right? Finance is not speculation, right? Investors take the other side of these trades, but the counterparty is always building something. They're always trying to build a bigger and better economy. And so really, finance enables us to do this. It enables us to get the mortgages to build these buildings, enables the producers to hedge out their risk, to be willing to build more and more things. And so in my opinion, finance is the big idea out there because it is what orchestrates everything that happens in our lives and the economy. And everything that we've just gone through, this enormous amount of financial innovation, happened in the last 60 years. And it happened because of something called dematerialization. So for the first 360 years of finance, everything was physical. Paper stock certificates, paper bonds, paper ledgers. But in the late 1960s, there was something called the paperwork crisis in the New York Stock Exchange. And in 1968, the New York Stock Exchange had to shut its doors every Wednesday afternoon to clear all of the trades that had backed up because they couldn't update it. Now, luckily for everyone in this time, there was a new invention called the computer. And some brilliant person said, why don't we turn everything in the world of finance into a ones and zero in a database? We dematerialize, over the last 65 years, we have dematerialized everything. Money, stock, bonds, derivatives, everything you can imagine became a 1 and 0 in a database that replaced all these ledgers. And that completely changed how finance operated. First and foremost, it gave us huge efficiency gains, right? It became easier to issue, trade, settle, and lend every financial asset in the world, which brought more participants and more capital into the financial markets. We were able to fund and build more and more things with a more efficient and global market. Next, we were able to issue new products. So for the first time, we could securitize loans, right? We could bundle loans up into securities and sell them to investors, enabling us to create more and more loans and more economic activity financed through debt. We were able to create mutual funds and ETFs. It was very hard to update the books of a closed-end fund with paper certificates prior to dematerialization. Since then, it's been incredibly easy to build these products. We were able to create derivatives on financial products. Using paper, it was impossible to create an interest rate swap. How would you do it? With a 1 and 0 in a database, you could create it, and now the interest rate swaps market is the largest financial market in terms of notional volume in the world. And finally, we could create complex structured products, right? These structured products are the bread and butter of large financial institutions. They enable individuals and businesses to hedge out complex risks. They make a lot of money for these banks, and they were all made possible because of dematerialization. Now, with the rise of these products and more efficiency, we also saw new businesses get created. It's no surprise that the first hedge funds came about in the 70s, 80s, and 90s, because for the first time, you could efficiently trade stocks, you could efficiently hedge out your risk, you could efficiently trade on margin, right? All the things that a hedge fund needs to do. We saw the rise of private equity, right? Private equity needs securitization to fund their businesses, their leveraged buyouts. They need the junk bond market. They need private credit markets. You know, Blackstone's largest business line is its real estate private equity group, and that can't exist without commercial mortgage-backed securities. We saw the rise of high-frequency trading, right? You can't quant trade paper stock certificates. It's impossible. And we saw the rise of personal financial apps, all of which are built on top of these dematerialized databases. And as this happened, we saw an enormous hockey stick growth in financial innovation. So from 1860 to 1960, finance as a percentage of GDP increased about 1%. From 1960 to 2006, we saw this enormous growth, right? And during this time period, right, the US economy grew massively and prosperity increased, right? And so some people will look at this chart and say this is a problem, and I would say this is only a problem when financial innovation stalls. When financial innovation is growing and efficiency in the markets is growing, everyone benefits. Now, the problem is that dematerialization has its limits, right? To execute this system, we created a kludge, right? And so this is a simple diagram of what it looks like to clear and settle a single stock trade today. We have two clearinghouses, DTCC, that settles the stock, and we have the Fedwire system that settles the payment. Every time a message moves through this system, a different ledger is updated and has to be reconciled. And there are several financial intermediaries that try to make these separate ledgers talk to each other, but it's incredibly inefficient and antiquated. And this kludge exists everywhere in finance, and none of them speak to each other. So we have a different database for equities, options, futures, and OTC trades. On the payment side of things, we have Fedwire database, an ACH database, a CHIPS database, and SWIFT. And we have a few financial intermediaries that sit in the middle with their own metadatabases trying to stitch this all together, but it just doesn't work, right? It worked really well for a long time, but we've reached the limits of what it can do, right? And that's because it kind of has three major issues. The first is we have so many duplicative ledgers, right? We've gone through that, right? More importantly, the message and the ledger are separated, right? So when I trade a stock, I send an email, I send a Bloomberg message, I make a phone call. But someone else has to move the money in stock. Someone else has to track that stock through various ledgers, right? Nothing is kind of reconciled together, and that leads to enormous back office issues. And then finally, there's no interoperability, right? None of these ledgers talk to each other. And what this means is that we've picked all the low-hanging fruit in finance, right? So since 2006, finance as a percentage of GDP has stalled, right? And think about this. During this time period, the stock market has been on a rocket ship, right? So much wealth has been made in the public markets during this time period with no innovation. And that's what I think is the problem with finance today, is that we have no innovation left. This system we've built has reached its potential, and we need something new to happen to kind of reignite innovation. And I think just like how the computer showed up at the perfect time in 1968, I believe the blockchain is showing up at the perfect time. So I think we're about to enter the third phase of finance, or finance 3.0. So we're going to go from physical, the dematerialization, to the blockchain. And to kind of think about how this system will work, I'll take you through a simplified tech stack of what this would look like. So at the bottom, we'll have an L1 or L2 for settlement execution. Next, we'll have to build compliance systems, right? Not every financial application on these networks will need compliance. We'll still have permissionless systems, but some of them, we're going to need compliance, right? Because identity is the foundation of all modern financial services, right? We need to be able to do KYC and AML. We need to be able to have RegTech to track everything, and we need arbitration to settle disputes. Once we have that, we can issue any asset in the world on these blockchains. Payment tokens, equity, private funds, credit, derivatives, and crypto, all combined together in a single global asset ledger. On top of that, we'll build simple financial primitives. Some of these have been built today, but more can be built. Then we'll have an interface layer. We'll still use our crypto wallets to access a lot of this, but I think we'll also have integrations into legacy systems where people don't even know they're using crypto, right? I think Robinhood's tokenized stocks in the EU is an example of this. And then finally, I think we'll have a host of AI agents that will intermediate our experiences for us in unique ways. And on top of all of this, we'll have huge innovation in the front-end app layer. And this stack completely obliterates the kludge that we went through earlier, right? We have instant settlement and reconciliation, right? Think about when you use crypto. When you click send, when you click buy, when you click trade, everything happens instantaneously. The underlying ledger is updated and ownership is transferred immediately. Right? We have instant and seamless onboarding, right? It's actually pretty amazing when you use crypto and you click connect wallet and you're using the financial services application. When we put KYC details in our wallets on chain, we'll be able to do that with any financial service in the world. We'll have an interoperable ledger for all assets, right? All of the assets will be able to speak to each other for the first time, enabling cross-margining and other experiences we can't even imagine. And everything will be composable and programmable. We'll be able to build simple financial primitives via smart contracts and stitch them together into complex financial experiences. And this is a big idea for two reasons, right? The first is that we know conclusively that instant settlement unlocks innovation and usage, right? So the BIS did a study of fast payment systems, and that's basically like UPI in India or PIX in Brazil, which enable instant settlement of payments within a global bound, within a nation state. And when these systems launch, they see a huge growth in fintech innovation, right? Fintech companies start to build new experiences, and those experiences overtake incumbents, right? There's this huge period of enormous innovation and growth. And we're already seeing this today, with stablecoins, right? This numbers get thrown around a lot, but it's an amazingly impressive feat that even in a few years, we now have $8.5 trillion in stablecoin transfer volume, right? And there are statistics out there that say that the Mexico remittance corridor is now stablecoins represent high single digits, right, in a few years, right? This shows what instant settlement of financial assets can do on global ledgers, and I'm incredibly excited about what it will mean when we bring more and more financial assets on chain. And I think just as important, we've seen examples that blockchains produce cost savings and efficiencies, right? Like ripping out the kludge and putting in this system changes how back offices work. So Franklin Templeton has a on-chain treasury product, and they said that to take 50,000 subscriptions would cost in the analog world would cost $1 each, so it's $50,000. Their blockchain product can take 50,000 subscriptions for $1.52 total, so a 99% cost reduction. JP Morgan did a proof of concept where they moved 100,000 private wealth clients' portfolios on chain. They then managed the updating of those portfolios, and what they said is that in the analog world, it would take 3,000 operational steps to update this portfolio, and the blockchain took a few clicks. And then Figure Markets, or now they're called Figure Technology, one of our portfolio companies said that by using smart contracts on the Provenance blockchain, they can save 100 basis points of savings per loan they issue, right? When we combine innovation from instant settlement plus these cost savings, I really think we're going to see an entirely new financial services ecosystem, and I'm incredibly excited about what it means. But to get there, we have to build more, right? The stack is not finished, and I think this means that there's enormous potential for what entrepreneurs and builders can do. And so I think there are 4 missing pieces today. The first is identity, right? As I said before, KYC AML is a cornerstone of institutional financial experiences, and we need to figure out how to expand upon the proof of concepts with verifiable credentials and verifiable data registries. We need privacy, right? No financial institution or individual is going to do all of their financial experiences on chain without privacy. We have experiments in zero-knowledge proofs, fully homomorphic encryption, in private zones and selective disclosures, but somebody needs to figure out how to make this a core primitive of all blockchains. We need interoperability. I'm not naive enough to think that we'll have one ledger to rule them all where every asset in the world exists on it. We're going to have a bunch of L1s and L2s with different ledgers, and so we need an interoperability solution to stitch these all together into a meta ledger. And then finally, we need reversibility and arbitration. We need recourse for fraud. We need recourse for mistakes, and we need the ability to arbitrate a legal dispute with what happens within a smart contract. And this will make finance safer. And so if we can build these 3 things, I really think we can achieve the vision that I've been talking about. But I want to end with a few additional thoughts, right? This is not just me standing on stage, waving my hand, saying, we could all build this, look what we could do with blockchains. No, this is happening right now, right? The wave is happening, and it's happening for 2 reasons. The first is that we finally have regulatory clarity. After 10 years in the wilderness, wondering if what we were doing was legal or not, that's all changing, right? So the Trump administration has made stablecoins the law of the land with the Genius Act, and the SEC has stated that they believe blockchains will be the foundational component of the next generation of financial services, and they are building the tools and sandboxes to make this happen. And just as importantly, the institutions have showed up, right? They're bringing assets on chain. It's happening right now. JP Morgan has done numerous proof of concept tests and initiatives. They even launched a payment token recently. Stripe just announced they're building an L1 for payments. Robinhood has tokenized stocks and says they want to tokenize many more assets. BlackRock and Franklin Templeton have on-chain money market funds, and the CEO of BlackRock says he wants to tokenize every asset in the world. Apollo has tokenized some of their private credit funds, and Kraken and Coinbase have both said they're going to tokenize equities, right? So more and more assets are coming on chain. The time really is now. This is all happening right now. And I really believe the future of finance is bright. And I want to leave you with kind of 4 thoughts of what this world could look like 5 to 10 years in the future. So the first is, I think investing, banking, and spending will blend together. Once you have all of your assets on chain in one place, you won't need to hold as much cash as you might used to, right? You could add a swipe of your credit card or a click of a button. An agent could convert your assets into payment tokens. An agent could just convert whatever you need to subscribe to a fund. And so the vision for what we think of as investing and banking and spending won't be what it is today. I think we'll have a huge democratization of finance. Once we have our KYC details in our wallets, we'll be able to subscribe to any product in the world, right? No one will be limited by their income or geographic borders for what they could participate in. I think we'll see infinitely customizable structured products, right? When all these assets are on chain, we're going to be able to build things that are fascinating, right? So imagine you have one person that says, I want the highest risk product you can give me. And someone says, great, I'll build you a product that has meme coins, a leveraged ETF, a perp on an L1, and a few high growth, low income software names. And they bundle that all up and they put it into a single token and they give it to you in your wallet. On the flip side, someone could say, that is crazy. I want the safest yield product you can give me. And so so it says, great, I'll build that for you. Here's a private credit fund, plus a carry trade product, plus some treasury bills. Bundled it up into a token, here's your yield. And everything in between those two spectrums will be possible to be made. And I think we'll see a huge competition and a huge set of innovation as people can build more and more of these products. And then finally, I think we'll see the rise of agentic robo-advisors, right? Once you have these assets on chain and you can build AI agents that have permissions at the wallet level, people will start building systems where you say, this is what I want to do with my finances, and then the agent will execute it on it, right? We'll have innovation in what can be built with these agents, and we'll have people start to tweak them themselves. And I think we'll see a whole market rise of who can build the best AI robo-advisors. And again, this will completely change how people interact with finance and what they think finance is. So I'm really excited about what this world could be if we build it, and I hope all of you in this audience help me do it. So thank you very much. Thank you for spending your time with us, and I look forward to meeting all of you later.